Good morning, everyone. Thank you for joining us. Today, we have an interesting session on how to buy a house property with mutual funds. So, selecting mutual funds for house property is not a big deal, but we'll be looking at other factors which help you decide the home purchase goal and how to keep it within your reach and how to avoid common pitfalls that, that are increasing day by day because of the availability of loans, new lending systems in place. So, in this workshop, we are going to cover home purchase goal and how to plan for your home, and we'll see what it takes to buy a house worth rupees 50 lakhs in today's scenario. We'll compare EMIs and SIPs, and we'll see what happens if you have cash and you use the cash to buy the house or you take a loan to buy the house. And in the all through the workshop, we can take questions if you have any. So please continue to post. And before we move ahead, a small disclaimer: anything that we discuss in this workshop, anything that all the numbers you see, any brands that that you come across in the workshop, these are not endorsements. These are only coincidences, and they are just part of the example that we have prepared. Also, nothing in this workshop should be construed as a advice. It should be for a personalized advice. It is recommended that you consult with your financial planner or financial advisor. This workshop only gives you scenarios and explains there are different situations which you may not be aware of, and different things you can look at from different angles. So, the common quote: know your goal and know yourself. The actual quote is you should actually, if you want 100% success anywhere in your life, Sandhu says you should know not only your goal but also yourself. Those who do not know their goal will only succeed, will not even probably be in the race. Second is those who only know their goal and not themselves will only succeed 50% of the time. So that's what his calculation is. But it applies pretty well to the financial planning scenario that you should plan for the goal, and to plan for a goal you need to know it pretty well. So this is what we are trying to do with these workshops. And one of the things that is often overlooked while buying a house, because house purchase is one of the bigger goals which happens in your life after retirement. It's one of the second biggest goal in the life, and lot of things, and because it has a lot of ownership value, lot of emotional value, sentimental value, that so you tend to ignore a lot of things as an investor, as a buyer. So it's very important to consider your actions in the present while purchasing a house, that it should safeguard your future, because most of the time house purchase is not a regular thing. It's once in a lifetime thing for a lot of people, and you may end up buying one or two properties or maybe three properties throughout your life, but all of these investments are pretty huge in nature and they have a long term impact on your life. So with this principle in mind, let's move on and see how a home purchase goal should be a smart goal. So smart is simply abbreviation for specific, measurable, achievable, realistic, and time bound. So any goal that we tend to define have to be defined within these parameters, these five parameters. First of all, it should be specific. We should know whether we can try to specify the home purchase goal as well, whether we are buying a high-rise apartment, low-rise apartment, land. We are buying land in a certain place, or an independent house or villa. So you can define the kind of property you're looking for, and that will end up defining your uh, cost of the property. It could be 50 lakh, it could be 1 crore. So I've just taken a 50 lakh average amount, which is pretty good for apartments and in some cases land as well. It should be achievable. So you can plan to buy land in a place where you are allowed and you're legally, the land is legally available to you for buying. So we are not buying a land in the middle of the lake. We are not buying a land on top of a very high mountain or in a forest area. We are buying land in urban settlements or semi-urban areas where residential plotting is allowed. So, and then it should be realistic. So, if you're earning 20,000, 50, 30,000 rupees a month and you want to buy a crore rupee worth rupees property, that is a kind of unrealistic expectation right now. When you have that kind of income, then probably it will be more realistic to plan for such a goal. So you can have a dream about that kind of property, but it cannot be a financial goal right now. And second thing is, and the last thing is, it should be time bound. We cannot have an infinite open window approach to financial planning. It has to be time bound so that you can decide how much you can invest and how much will you will need to invest to achieve the goal. So it becomes an achievable time bound milestone rather than a dream. Then, so that was how you define the goal. Now, for the purpose of this workshop, we'll be defining certain limits. We cannot do planning for all the kinds of home purchase goals. So we'll limit ourselves to certain specific types of properties and types of transactions. One of that is we are buying an apartment. We are not buying land. We are not buying a villa. We are not buying under construction property. We are buying a ready to move in property. We are not constructing on a land or anywhere. We are open to home finance option. That is, financing option is available from prime lenders on that kind of property, and you have consistent regular income to meet to look after the EMIs if you go for a loan. So these are pretty common conditions. I hope this covers a lot of people. Even if it doesn't, I'm assuming that you will at least be able to hold the EMIs in the proper due date. Now, when you plan a house, you need to you will be looking at multiple properties, multiple features that these properties will offer, and so some of these features will be good to have, and a lot of these features will be must-haves. So initially, you should try to ignore the good to have features like clubhouse, swimming pool, temple access, and builders can add a lot of fancy stuff to that. But you should see behind the curtain what quality of construction the builder is providing, what kind of plumbing, electrical, and uh, finishing builder has provided, what the location of the property, whether it is secure, safe, how well safety is there, what kind of maintenance they provide. Is there discrepancies in build-up areas and carpet areas, what the numbers say and what the actual property looks like? Parking, whether the parking space is available or not. So these are kind of must-have features that you should be looking at while searching for the home. And so this only means that you will be looking at multiple different options before finalizing that you want this property. And going forward, we'll come to know why. So assuming that you are trying to buy a 50 lakh worth house, so this is if everything remains normal and nothing exceptional is happening here. So this is what your cash flow would look like. 50 lakh is the gross value of the property from the builder. We are also assuming that we are not going to a proper real estate agent to buy a house. We are buying a new house directly from the builder, and it will cost us like 50 lakh rupees. That is the quoted price from the builder. And for this, to register this in Delhi or UP or some of the northern states, the stamp duty and registry charges are come about 7 to 8%. So I'm assuming at the lower end, it's 7%. So you will end up paying 3.5 lakh rupees to for registry and stamp duty. I'm not including cash expenses here. That will be another 20 to 30,000 rupees. But let's consider that covered within this amount only. And then maintenance and security for 1 year, you will deposit 52,000 rupees with the builder, and you'll also make a deposit of about 80,000 rupees for utilities to be provided to your apartment. And then there is when you receive the apartment, when you're ready to move, you will also spend money on interior works so that it becomes livable property. So assuming that you spend about 5 lakh rupees, so total cost of ownership of 50 lakh rupees apartment will come down to almost 60 lakh rupees. That is 59.72. So your actual cost in reality could be a little bit higher or a little bit lower, but it will be around this number if you are looking to buy this kind of property in Delhi NCR or any metro cities. Now, if you buy it with a loan, including you will be paying down payment, you will be paying insurance cost and everything. So immediate cash outflow from your own pocket will be about 16.6 lakhs for this kind of property. That includes registry costs, that includes any cash, all the cash expenses we just saw, utility expenses and security deposit. And then there will be so what is left is you will also pay about 10%. So loan is not available at 100% of the property value. It's the maximum loan you can get is 90% of the asset value. So you will be getting loan at 45 lakhs, and 5 lakhs you will be paying out of your own pocket. And assuming that you secure a very low interest rate of 8.5%, you have a good credit score, good CIBIL, and then you have a 20-year term of loan, and your EMIs will be about 39,000 for this. But if you buy in cash, you also already saw that it costs you around 60 lakh rupees, including the interior work and everything. But most of the time, if you are buying a home very early in your life, like in your 30s, you will be buying, you're most likely to buy a home with a home loan. So if you're buying it on a home loan, this is your scenario. You're paying 16 to 17 lakhs out of your pocket. 45 lakhs is your loan amount. You're securing a very low interest rate. You have a long term, like 20 years, 15 to 20 years of loan repayment term, and your EMIs will be about 40,000 rupees. Now, going forward in 20 years, if everything remains consistent, nothing changes, you will be paying 1.24 crores to the lender. But the reality is, loan rates will keep on changing. Initially, when you get the loan, there are a lot of discounts that are offered to you, and that's why you get a loan at a very low interest rate. But going forward, these discounts will disappear, plus interest rates will rise, or CRR will rise, or RBI may tighten cash reserve ratios for the bank, tighten monetary policies. So you're most likely to face a rising interest rate than a declining interest rate on long-term loans. Their impact is usually ignored. You don't you don't have any way to calculate, and banks are pretty happy to give you loan at a lower rate of interest. You are pretty happy to get that kind of loan. Now the thought behind is if my rate of interest is low, that means I'm saving money. I'm paying less interest, but we'll see how true that is going forward. Then, if rates increase, instead of your EMIs don't go up, your loan term goes up. So instead of paying 240 EMIs throughout the tenure, you will be end up paying like 260 EMIs or even 300 EMIs if rates go very high. Also, there is EMIs have a time bound nature. So if you are supposed to pay EMIs on 10th of every month, you will have to pay on 10th of every month. Delays of 1 or 2 days will cause bounce charges to the bank, to your account, and then the lender's account as well. So you end up paying both the penalties. Plus, there will be additional interest that can be charged on non-paid EMIs. One of the benefits is you may get a rebate on your income tax for the interest and principal amount that you repay on the home loan. Now, the most ignored part of home loan purchase transaction is the opportunity cost. So there is opportunity cost with every cash flow that you consider, and the problem is with smaller cash flows, it doesn't matter that much. With something you are buying for 1 lakh rupees or 2 lakh rupees, the opportunity cost is nominal. Like it could be as high as 20,000 rupees or as low as 2-3,000 rupees. So it doesn't actually affects your affect your financial health that much. But when it comes to a transaction involving 45 or 50 lakh rupees, on which you don't have enough cash, uh, as much cash in your account as you're going for a loan, then the impact is very high. And then it's very important to consider the opportunity cost of different things, different incomes you might be using, different expenditures, the cost of loan, everything has to be in your uh, calculations in your accounting for this. And this is not possible through mental accounting. And you will realize as we move forward, you will realize how much wrong mental accounting you had done in your purchase if you have been through such transactions before. So there are four opportunity costs with the uh, home purchase. One is if this is your first property, if this is a property that you want to live in, the opportunity cost is of rent payment, the rent that you are paying. The opportunity cost is associated with also the EMI payments and the amount of cash you spend on purchasing the home. So you will anyways spend about 16-17 lakh rupees for a 50 lakh property. You may spend, if you have 60 lakh rupees, you can also spend that 60 lakh rupees. So then the opportunity cost will be associated with both, and both has to be counted because it is not in thousands. It's always in equivalent in lakhs. So even 10% of 17 lakhs is 1.7 lakhs. So let's see what the opportunity costs actually look like for a 50 lakh property. So the rent you are paying, assuming so you are already residing in a property worth rupees 50 lakhs. So rent payment over the course of next 20 years, considering all the time value of money and everything, the growth of rent and everything, you keep on living on rent, you will end up paying 1.7 crores in 20 years as rent. But if you take a home loan and you start residing in the property, you take a home loan for 20 years, everything remains consistent, 8.5 percent rate of interest on the loan. You pay 240 EMIs of 39,000 each. You will be ending up paying 3.36 crore to the lender for the ownership of this house. Obviously, you forego the rent You don't pay any more rent once you purchase the property, once you settle in it. So we can remove the 1.7 crore cost to you from 3.36 crore. So it's almost 1.7 crore that you actually save. You only spend 1.7 crore if you go for a home loan, if you purchase a home and start living in it. Then there is cash purchase or loan. So if you spend 60 lakhs, we already know the opportunity cost of EMIs. So if you take a home loan and pay EMIs, the opportunity cost is 3.36 crores, including the cash expenses. But if you uh, spend the entire 60 lakhs in cash, it has the same opportunity cost. So whether you pay it immediately or whether you take a home loan and pay it over 20 years, you end up spending pretty much same, except for a few conditions that we have discussed once, that interest rates on the loan, on especially home loan, is never consistent. It's mostly a floating rate of interest. Even if you go for a fixed rate of interest loan, after every 2 3 years, it does not change as fast as floating rate, but after every 2 3 years, bank will revise the rate of interest, and you will have a new uh, lending rate that will continue, and it is always higher than the floating rate of interest, at least initially. Now, in all the calculations that we have done so far for the EMIs and everything, that we saw the opportunity cost, EMI calculation, and the total amount that you end up paying when you take a loan, is that the rate of interest on this home loan has remained at 8.5%, which is the initial home rate of loan that you get from the lender when they want to get you on board as a customer, and you are desperate to buy a home. You have already finalized the property, now you just want to finalize the loan and get the ownership of that property. But the reality is, this initial lending rate is heavily discounted. Within 6 months of taking the loan, you will realize that the rates are increasing. The loan that had started at 240 EMIs only has now gone up to 249, 250, or 260 EMIs. Going up to 260 or 300 EMIs means that 20-year loan has just now become a 25-year loan. So, and most of the time you will get a home loan at floating rate of return. And as we discussed, bankers love to give you this loan at a low rate of interest, and you love to take the loan at low rate of interest because you think that this will help you pay less amount of interest. But what happens is what comes next. So if everything remains unchanged and you secure a loan at 8.5%, your EMIs will be 39,000. You will have a tenure of 20 years only, 240 payments. Total amount you will pay is 93 lakhs. But if the interest rate rises to 9%, your EMIs will start, and your EMIs will remain the same because banks don't change the EMIs uh, once the financial underwriting has been done on a loan. EMI will remain consistent. They will keep on increasing or decreasing the tenure to adjust for the increase or decrease in the rate of interest. So if the rate of interest goes up to 9%, your tenure rises. Your tenure will become more than 240. It can go up to 260 payments. So if it goes up to 260, your total amount payable for the loan will become 1 CR, from 93 lakhs to 1 CR. And then if it rises to 9.5%, you end up paying 300 EMIs, and total amount that you will repay to the lender is 1.2 crores. It's a difference of 27 lakhs from the initial promise that you considered, you accounted for, and thought, okay, I'm paying this much, this is okay. But after 20 years, you will realize that a large part of the loan is still pending. And if you continue to repay, it will be 1.2 crores in total. And then there is, so what you need to do is, if you get a lower rate of interest, what will happen is change in rate of interest is inevitable because economic conditions keep on changing. Banks keep on lending at a lower rate initially, but they keep on borrowing at a higher rate of interest. So they need to repay to their lenders, and they will eventually have to raise your rate of interest for a long term loan, such as home loan. So, one of a couple of things we can do, and we will see the impact of these things. So, if you take a loan at a lower rate of interest, the chances of you ending up paying a very high amount, very high price later is higher. If I start a loan at 9% and then the rate of interest rises to 9.5, I will not be paying 1.2 crores. I will end up paying one. I will only pay 1.1 or slightly less than this amount. So it's the starting. If the starting point is low, the fluctuation in the total amount is very high. If the starting point is slightly higher or without a discount, for the same, if the same EMI is continuing, you will end up paying less amount of money. So to, to give you a perspective on this, let me show you something that I usually don't share on a live session. Now, this is a loan where of 45 lakh rupees, where the tenure and everything, I had a tenure of 20 years, that is 240 EMIs in the beginning. And I started with a 8.5% interest rate on the loan. My total amount paid is 1.24 crores in 20 years. And in not 20 years. So initially the tenure was 20 years, but after 6 7 months, economic conditions changed and banks suddenly increased the rate of interest. And instead of 240, I suddenly was expected to pay 259 EMIs. And then 6 7 months later, again a slight increase happens, and instead of 259, I was paying 269 EMIs. So at the end of the loan period, my loan closes after all these fluctuations, I had paid 319 EMIs to close the loan. And this ended up increasing my total outflow for the home ownership, and it became 1.24 crores, whereas it would have been 93 lakhs or something. But one of my more intelligent friends, what he did, he didn't go for the discount. He was not attracted by it. He got a 9% rate of interest. Also took 20-year loan. So he was supposed to pay 240 months 240 EMIs, but his EMI was slightly higher. He was paying rupees 40,000 per month. But after all the fluctuations and everything in the rate of interest, his total amount paid is only 1.12 crores. So he saved almost 12 lakh rupees on the total loan payment because he paid less number of EMIs. So last time in the previous, I paid 300 something EMIs. He paid only 280 EMIs. His loan was closed in 280 EMIs. Another friend who was even smarter, he also reduced the loan, the term of the loan. He said, no, I will pay only in 10 years. I don't need to wait for 20 years. He paid a EMI of 57,000 per month. But his total outflow in 10 years, after all the fluctuations, he also experienced interest rate increases and everything. But his total outflow is only 71 lakhs. So this is one of the scenarios that we always miss out. When it comes to uh, a big financial decision such as home loan, home purchase. So if you are buying a home with a loan, or if you are buying it on cash, the opportunity cost remains the same for the same property. So what? So your question would be, why should you worry about investing to buy a property? There are multiple reasons. It's buying a property is not just maths. Property has, as I said, and there is a lot of sentimental value. There is a lot of value in the ownership of the property. There are a lot of fundamentals that go into purchase decisions, including your professional, including your profession, including your family preference, including the location, including the growth that you are experiencing or the economy is experiencing. So if you have somehow accumulated that kind of cash in your bank, should you spend that amount on, and should you go forego that amount and get a property, turn that amount, that money into property immediately? So as you see, there are a lot of risk factors. Once you buy a property, you are stuck, and then you will have to consider all the risk factors of that property in the future. So the best thing to do, if you have the cash and you are considering buying a property with that cash, you can hold on to that cash and consider a home loan, just like the smartest friend in the group, who took a loan only for 10 years instead of 20 years. And in 10 years, you will end up paying about 72 lakh rupees after all the fluctuations, or maybe 75 lakh rupees at max. But in 10 years, your 45 lakhs that you retained in your investments can become 1 crore or more with mutual funds. You can invest in mutual funds. You can have a with 45 lakhs. If I think PMS services are uh, uh, demand 50 lakh rupees corpus. But if you have 45 lakhs invest in mutual funds, you will still get good amount of money 10 years. 10 years is a pretty good time. You can invest at a high risk equity mutual funds and let your money grow while you also purchase the property, start living in it, and your opportunity cost will be, because you are foregoing the rent. If you are living in the property, you are foregoing the rent. You are not paying rent anymore. So you are retaining the rent and you are paying EMIs. Your opportunity net opportunity cost is about 1.7 crores instead of 3 crores. But if your loan is 10 years, you're only paying 71 lakh rupees. And even if you don't account for rent payments and everything, you still have a surplus of 29 lakhs in 10 years. But if you had spent this cash and you said, okay, I will pay the entire amount in cash and entire 60 lakhs in cash, uh, you will not have this cash surplus. So once you have accumulated the amount, enough amount to buy your dream property, you should not spend it or right away convert that amount into real estate. You still have, because there are a lot of risks in the future. It's a long term transaction. The property can stay with you for lifetime, or you may get bored with it and give up within 5 years and you have to sell it off. So what happens if you sell it off? The only reason you will sell it off is either you are moving to a very different location, you can't maintain that property maintenance is a cost if you're not residing in it, you can't rent it out, and the rental value is not that great. So that means external factors are impacting the return, the value of your property, the growth. The area has not seen that kind of growth. So there is a lot of risk with purchasing a property. So if you have the money, you should hold on to that money so that it can help you manage future risks. And you can use a long term, a medium term loan to repay the property. If you get bored with the property, close the loan, sell the property. If you retain the property, you still have surplus. And the cash that you had is always accounted for. And this is I would say, core principle of handling money is that you always have to account for it. If you get a bonus, invest in invest it in such a way that after 5 years you will say, okay, what happened to that bonus? That bonus is here. It is giving me this value. But if you spend it on something which depreciates in value, like you buy a car, it depreciates after 5 years, the car has to be replaced. Where is that bonus? You have no idea, because that bonus was not enough to buy the complete car. You uh, also added some value from other investments, or you took a loan. So the bonus is gone, the car is going, so you are not left with a car or money. So instead of that, what we need to do is we need to retain the cash as much as possible and account for it with investments. Where do we invest? Since I am a mutual fund advisor, I would mostly give you the mutual fund game. Okay, invest in mutual funds, different kind of mutual funds. But there are other investment options also, which are equally lucrative or even more lucrative. We can look at. But mutual funds are pretty basic investments. They are simple to understand. You can simply park. There is no magical thing going on between investor and mutual fund. It's simple relationship. You invest the money. Mutual funds invested in stocks or bonds, and there is a fund manager managing your money. And whatever returns mutual fund generates is available to you. If you liquidate the mutual fund unit, you can sell it off and you can take your money back. So how do we select different mutual funds for you is, we first of all determine your investor risk profile, how much investment risk you can take, how much you can handle, and what you are comfortable with. If you do not understand equity, if you are not comfortable with equity investments, investing aggressively in equity is more likely to give you losses than good returns. So we can only take the risk as much as we can manage it. So we'll consider that while determining your risk profile and how much time you have available. If you are investing for 5 years, will not take as much risk as if you are investing for 10 years. And this is a map of timeline plus your risk profile, how we can select different types of funds for different people and for different goals for these different people. So on the left, you see the three types of risk profiles. Aggressive investor is the somebody who loves investing in stocks and understands what how their risk profile works. And then there is a moderate investor. Then there is a conservative investor who is more comfortable with a safe return where he has no worry about losing the principal. And but the returns are inflation adjusted. Money is not losing its value over time. It remains consistent. Aggressive investor is more focused on generating wealth. That I have 1,000 rupees now, I need 10,000 in 10 years. So that kind of investor would be aggressive and they will try to invest in very aggressive investments. Usually, the more time they have, the better it is. So the more time they can give, the more aggressive our investments can be. Now you can post your questions in the chat window, or you can raise your hand and I will try to answer them. Or you can alternatively post your questions to these details. This is on WhatsApp number and email ID, or you can go to the website and look for your queries. Plus, you can post your queries on the website itself. Thank you very much for joining in. Have a great day. Looking forward to your queries answering them. Bye bye.